And welcome to this session on state and local taxation. I am Donnie Charleston, your moderator for the afternoon. I hope you guys are enjoying your time here at the SelectUSA conference. I am the Director of State and Local Fiscal Engagement with the Urban Institute House here in Washington, D.C. We're a 50-year-old research and policy organization founded by President Lyndon Johnson back in 1968. And our whole goal is to connect policymakers with research and insights that can better inform their decision making. And we hope to bring some of that insight to you here today. I have the honor of moderating this distinguished panel of individuals who are experts in state and local taxation. And we'll go down the line, these individuals will introduce themselves, and we'll get into the meat of this discussion. To my immediate left, I have John Cesaretti, tax principal with Crowe LLP.
Hi, I'm John Cesaretti, tax partner at Crowe. My role at the firm, or I should introduce Crowe. So Crowe is the 8th or 9th, depending on the year, largest accounting firm in the United States. Most of our clients are middle market clients, so $5 billion or less typically. My role at the firm is I lead our Chicago state and local tax practice, and I also do our national incentives practice. And also, kind of interestingly, I think, I'm on my local school board.
And to his immediate left, we have Allison.
Hello, Allison Forbes. I work for the Center for Regional Economic Competitiveness and the research director there, focused on economic development, workforce policies, and investments. I also support the Council for Community and Economic Research. We're a small nonprofit in Arlington, Virginia that has a big community of researchers in labor analysis and economic development across the country.
And next we have Steve Carter.
Good afternoon, Steve Carter. I'm Managing Director with Grant Thornton LLP. Grant Thornton is also a large global accounting firm. I sit in the Cleveland office. I've been in state and local taxes now for 23 or 5 years. I do head the credit incentives practice for the firm, and we'll probably hear more about that a little bit later. So that's a little bit about me.
And on the end, we have Paul Naumoff.
Hey, good afternoon, everybody. My name is Paul Naumoff. I lead EY's global location investment and incentives practice, and we help companies from around the world invest in the United States and also help companies here in the U.S. as they grow and expand. I've been with EY for just around 24 years, started my career at the Ohio Board of Tax Appeals, which is where all of the state and local tax appeals flow up, and have been working either on the tax compliance side of state and local tax or on the consulting side of state and local tax as we work with many of our companies who are growing and expanding around the country. So must be a thing about being involved with state and local taxes. I also, on my school board, I guess if you're going to look at all these taxes flowing through, you make sure they get spent in the right way to achieve great educational outcomes. So John and I, a little shorter over here, we know how to, sitting on a school board, to get beaten down a little bit. So.
Yeah.
Thank you for those introductions. A real quick check of who we have in the room. How many people are representatives of corporations or companies? Or would we have any government people in the room? A few government people. Anybody else? Consultants? How many consultants in the room? Any other consultants? Okay, a few consultants. All right, nice mix we got here in the room. Okay, as I mentioned in the opening, we are covering state and local taxation here today. And our goal here is to give you a good broad overview of some of the many issues you'll be facing as you start to consider your investment decisions across the United States. And the reality is the United States is a relatively small country compared to some. However, every jurisdiction in this country has its own different structure of taxation. We have 3,141 counties, which are subunits of state government, and with beneath that, you have over 19,000 towns and cities in the country. And so, in each one of those jurisdictions, you have overlapping and intersecting state taxation systems at the state and local level, and it can create a nightmare or headache for you if you don't really know what you're doing. And so, these individuals here are here for us today to kind of help us wade through some of that and help you make some decisions such that you can make great decisions for your companies and such that they are profitable. You're providing great returns on investments for your principals, as well as being able to, so that you can be great corporate citizens for the communities that you are residing and investing in. All right, so we've done introductions, and we kind of want to kick it off with kind of a softball question. The reality is many of you have heard a lot, and you may have went to the panel early today on tax incentives and some of the changes you've seen at the federal level. And we've experienced quite a bit of change over the last year or so with respect to the Tax Cuts and Jobs Act, and there are implications at the local level. We won't dig too deep down into those issues, but just kind of a quick 30,000-foot view of how some of those issues may play out at the local level. John, you want to kick us off with a little bit of that interpretation?
Yeah, I do. So my perspective, and I'm going to stick to the income tax side. So the Tax Cuts and Jobs Act came in at the end of 17. Seems like it just happened, but it was a while ago. And one of the things that it did was dramatically increase the corporate tax base for federal income tax. And the reason that's significant for state and local income tax is that nearly all states and localities that have income tax start their calculation with the federal income tax base. So when the federal tax base increased, the state tax bases in pretty much every state increased correspondingly. Now, the federal rate went way down, but the state rates stayed more or less the same. I mean, there are some states that saw an opportunity to reduce the rates because they knew they'd have more money, but most did not. And the projections, which were, I think, done by E&Y and cost years ago, was that the Tax Cuts and Jobs Act would result in 7 to 10% more income tax revenue coming in. And the numbers that we're seeing is that might be understated. So I think my perspective, the biggest impact is the states that didn't really do anything, because they didn't really have to do anything, to get the larger tax base have benefited pretty significantly by additional tax receipts. And I would cite Illinois as a good example. I'm from Illinois. Illinois came out of nowhere with $1.5 billion of extra income tax that nobody saw coming towards the end of the year. So help balance the budget. But I think it's stories like this in most states.
So that kind of creates a more complicated landscape than we even had before. Does anybody want to weigh in on some of the things that these individuals should be thinking about as they kind of weigh that increased complexity?
One thing I just would comment on is you look at, as John correctly stated, most states with an income tax will follow the federal changes, and therefore we're seeing, as alluded to, 12 to 20% is actually the projections, the increased taxes that are being collected by the states. So one element of this is the states are flush, if you will, and if you're going to consider doing business in one of those jurisdictions, perhaps there's available opportunities to reduce those costs through tax incentives. But I guess I would also point out that many states have set up more of a gross receipts tax structure as opposed to an income tax or a franchise tax structure. And in those states, they're not impacted at all by the federal tax changes that we've seen.
Mm-hmm. So Allison, you touched on two topics that you know a little bit about. One is tax structures, the other are incentives. So as you think about this whole new landscape, how are incentives playing out as companies? How are they playing out, and what should companies be thinking about?
Well, something really interesting about the Tax Cut and Jobs Act is an interesting provision. We work with a lot of state economic development executives, so chambers of commerce and state agencies, commerce agencies. So they've been really interested in a provision that creates opportunity zones across the state and brings increasing complexity to the landscape, but potentially in a really good way because it looks to drive investment in underserved areas. Governors across the country identified those areas that would be opportunity zones for their states, and there's opportunities to invest. They're not like neighborhoods, they're larger tracts of land. Puerto Rico is one of these opportunity zones. The entire land in that area across the country, other places are designated areas. So states are looking now to drive those investments into places that are going to have an impact in those communities, particularly looking at how to drive investments in businesses that are in those communities or that land there. Mm-hmm. So not just real estate development, but business development as well.
Mm-hmm. So go ahead.
I was going to say, some states have actually come out and passed their own opportunity zone programs as well. So if you're looking at the opportunity zone, look to see what the state's providing as well.
Mm-hmm. And it's building on a landscape of enterprise zones, reinvestment zones, and these kind of geographically targeted areas have been state policy for a long time, making sure that the businesses that are located there can make the investments that create jobs.
Mm-hmm. So in terms, do you want to get in on this? No?
Please finish. I had another comment on the income tax.
Go ahead.
I just want to note, we started the discussion around the Tax Cuts and Jobs Act and the impact on the states and their collections of corporate income taxes. We put the slide up here that really just demonstrates when we talk about state and local taxes, we're not just talking about income taxes or gross receipts tax at the corporate level. And just to note, property taxes and sales tax, for those of you who perhaps have not paid attention to your state and local tax bill or perhaps considering investment in the U.S. for the first time, property taxes make up about 40% of the collections. So if you invest in purchasing land, building buildings, machinery, equipment, furniture, and fixtures, many states will tax both the real property and the personal property, and that makes up about 40% of the overall collections. And we're talking about state governments. And then sales tax or consumption taxes, that's another 20%. Actually, the corporate income tax, that's only about 8.5% of the overall pie. So just really important. I know that this group works a lot, as indicated, with incentives, and a lot of times state governments and local governments are working to reduce the property tax and sales tax bills as a result of that being such a large portion of the collections as companies come in and invest.
Mm-hmm. Yeah, and I would, if I could, add just one last piece maybe to the federal income tax change. I think what we're seeing, so people kind of in this business of complying with these multi-state taxes are seeing is that a lot of the states are still trying to figure out what they want to do with some of these changes that the federal government made. So with the expanded tax base, the federal government threw in a bunch of sweeteners basically to invest, right? So we call it bonus depreciation, right? So you get to depreciate anything you buy in the first year, that kind of thing. So the states are still trying to figure out, a lot of them, what they're going to do with it. So we expect the landscape is going to be changing on the income tax side for at least another 2 years as the states try to figure out how best to optimize their income tax bases.
Mm-hmm. So it's influx, a lot going on. Going back to the comments you made earlier, Allison, from standpoint of opportunity zones, and so to actually benefit from that, you have to have unrealized capital gains. So stock gains, whatever have you, that you haven't cashed in on. So for individuals who may not have unrealized taxable gain, unrealized capital gains, they can still kind of piggyback on what's going on in those communities where other investments are being made. Could you talk a little bit about that?
Well, in forming an investment, right? So a business in that area could be the recipient of those investments for folks that have those capital gains to invest in those communities. That's my understanding.
It's a way to get funding, maybe for your project.
Mm-hmm. Yeah, and maybe you're referring to it's a very long term. There's an incentive to keep the money in the investment for a very long time. Yeah. So I think more than 10 years. And if you do that, there's a large tax benefit on the order of. And so go to your own tax advisor. Yeah. So do not follow what I'm about to say. But it's very large. So it might be a complete deferral of your capital gain into the future.
Donnie, I would just comment, and Steve alluded to this earlier, I think we're still fairly early stage with the state governments reacting. When they created the Opportunity Zone program, the governors were able to anoint these jurisdictions what was an Opportunity Zone, but they were using low-income communities from 2010 census data.
That's a good point.
And so they were able to look at existing impoverished areas and designate those zones, and those federal benefits will apply in the zones. But as you properly noted, you need to have a capital gain invested to directly take advantage of the program. Or as an investor, you may be able to invest into a fund that's been set up by somebody else and have a very tax-efficient investment. So there are opportunities at the state level, but I do want to reiterate, this is state and local taxes, and that's something that if you're in a zone anywhere in the country, you would be afforded the same federal level benefits, both as an investor or as a direct taxpayer who's realizing those benefits. I think it is early stage for the states. I think they are getting out and saying, okay, how do we really maximize this program? How do we double down on the opportunity here? And what additional enhancements could we put in to help some of the more impoverished rural areas and urban areas in some of these state and local governments? So we are seeing some states beginning to act. I know my home state, Ohio, has got legislation introduced that would enable you to have additional income tax benefits and corporate income tax, both personal and corporate income tax benefits, to help further incentivize investment into the zones. But at this stage, I wouldn't say we've seen broad-scale legislation introduced across the country, but it's still fairly early.
Yeah, I think time will tell. I think other states are also looking at co-locating investment in infrastructure and where opportunity zones are designated to further and spur that investment. So I think it's, like you said, a lot left to do and figure out, but I think it's a program with a lot of potential. So I think for all the individuals here, I definitely consider those zones as you think about your investment potential.
If I could, and so it's still, so the federal, and this is all federal law, but the federal treasury is working, I think, pretty hard to make the legislation as flexible as possible. And I think as recently as a couple weeks ago, a new set of regulations came out that were more flexible than what was there before.
Mid-April.
I don't see that
came out,
stopping.
Right.
Yeah.
And to take it back to the state and local level, a lot of these places will overlap with previously designated geographic areas where there's overlapping tax credits and incentives for businesses. So you're going to get those credits on your income tax, on your sales tax, on your job creation, et cetera.
And as you mentioned, some states have designated their own zones, which actually co-locate with the opportunity zones as well. So Allison, you mentioned structure a little bit earlier. Anybody can kind of jump in on this question. You mentioned as well, Paul, from the standpoint of different states have different structures of taxation from the standpoint of some rely heavy on the property tax, some more relying on sales tax, some more on corporate tax, some more on income tax. So as these individuals consider their investments, how should they be viewing those different structures from the standpoint of their own companies, even down to their specific industries?
Yeah. We would really view as a best practice, and I'm sure some of my panelists would agree, if you're looking at the United States for a new investment, or maybe you're here in one state and looking to go into others, you really need to sit down, step back, and have a modeling exercise that will help you look at, say, Ohio versus Indiana or the state of Virginia or whatever the case might be, and model out based upon your facts and circumstances, how much property do you intend to invest in this zone in terms of the value of the equipment and the buildings? How many people do you intend to employ there, and what's the payroll associated with that investment? And what are your projected sales, and where are those sales going to be in that particular state or around the U.S.? Because as we know, the corporate income taxes are typically administered based on a apportionment factor, and it will take into account your property, your payroll, and your sales in a particular jurisdiction. To model out the income taxes, you've got to get that data in place, and you can then do an apples-to-apples comparison across 4 or 5 states to determine which one is going to cost more from a tax perspective over the course of time. Now, that's just modeling out the corporate income taxes. To have a really true comparison, you want to look at the specifics of each state, and really these are some general categories there on the slide I keep pointing over here too, but 12 or so types of taxes, everything from sales tax to property taxes to carbon taxes to excise taxes, very different in each state, but many of them have commonality. So if you can measure those on an apples-to-apples comparison, you can look at your cost over a 10 or 20-year period and immediately have a better idea as to who is more competitive for your particular business. And that can come down to the industry, because there are special factors in some cases for different industries in different states. Now, you take the income taxes, and you ultimately, as you consider investing in these states, you'll look at state and local tax incentives that can offset property taxes, income taxes, sales and use taxes, and other types of taxes, as well as some cash grants, training incentives, financing incentives that help the upfront costs of your project. So what we find is a best practice, just to be very holistic, take a look at your financial modeling, incorporate the tax costs and the other business costs, and then you can very succinctly look at 4 or 5 states and rank those as to where is the best for my business, at least from a cost perspective. You may decide from a market perspective, from logistics, from where your kid goes to college, that there's a better spot to locate your business. But this is one way to put it together as a very much an apples-to-apples comparison.
But I'd say just don't look at effective tax rates.
Yeah.
There's a lot of information out there. We got the lowest effective tax rate. That doesn't mean a whole lot. Like Paul said, you have to go through the exercise. Are you a corporation? Are you a partnership? Is it taxable? Do you have tangible property tax in that state? I mean, that's a big deal. Ohio, we don't have it. Yeah. You go next door in Indiana, they got a property tax on tangible property. They give out abatements. So you have to do that full analysis to see about the apples to apples. And so, yeah, you got to do your homework.
So you mentioned homework, you mentioned a lot of resources. So what?
Can I add? One thing that I see clients do that may be surprising is they underestimate how big their success is going to be in the U.S. And I've seen this 3 times in the last couple of years. And so they plan for a sales office in California, and they end up with a giant client in Chicago. And they have to hire a bunch of people really quick, and they have to do all this backfill of work they probably should have thought about doing in the beginning. So I'd say don't be overly pessimistic about how things are going to go in the United States. It's not a guarantee, but I expect it would go better, and I frankly plan on things going better. Think through kind of where are your biggest customers that you want now? Should you be near them? Those kinds of things. And if I am going to have a lot of inventory, where am I going to get that? Where is the manufacturing capacity for that? So that's the biggest issue I see, frankly.
So what you made me think about was a question we were talking about earlier was, some of the future trends. What do you see as, down the line 2, 3, 5 years down the road from standpoint of taxation? Anybody can kind of piggyback on this question anyone?
Would you like to go?
Well, thinking about the states and localities as having potentially very different economic development goals, and that's relevant broadly for this discussion because I think this is really about making a good fit. So you're going to think about these very detailed questions and the tax portfolio of the state, but also states want to incentivize capital-intensive manufacturing businesses. They're going to have specific incentives that support those firms. They might have research and development tax credits that are particularly good for maybe not those high capital intensity projects, but for high knowledge intensity pharmaceuticals and high-tech industries. So there's a variety of intentions here. One emerging intention is towards job quality. So really making sure that fit with the local human resources, the local population is a good fit with the business. And that's really important for businesses too, planning for the future, thinking about how they're going to grow, where they're going to find that future workforce, as well as if their existing employees are going to make a good fit with that community and be able to continue their education and upskill throughout their careers.
Yeah, and I have something to follow up on that because it is really related. And I think, and I'm biased because I'm on the school board, but I think a lot of the future is going to be about how to pay for education beyond the traditional property tax. So I think most of the people in the room who live in the United States pay probably relatively high property taxes relative to maybe the rest of the world. And it's a function of how we run our local governments. They tend to be paid locally. And I think what we're seeing is in some states like, I'm thinking Oregon, right? Oregon just passed a gross receipts tax, and it's half the bill is about how to fund education. And oh, by the way, we want a gross receipts tax because we don't want to pay more property tax. So I think what we're going to see is more of that. Nevada, famously, I mean, these are really small states, but still, that's where we get our trends, is typically from the small states. Nevada did a similar thing. A bunch of people moved into Nevada, had much higher expectations of what public education should be than the people who already lived there, and they wanted more spent. And the Republican governor, about 5 years ago, said, okay, fine, I'm going to put a gross receipts tax in. And anyway, that's what I see is coming, more of those.
And it's not to say that all states and localities are looking for these high-wage, high-technology jobs. A lot of them are, but other kind of businesses can be a really good fit depending on what part you are, what location you are in a city, or where you are in the state. If you're a rural area, a call center could be a really great fit for one community and not for another.
So you guys have mentioned almost like this connection between taxation and then services. Mm-hmm. And so there's this balancing act that a lot of states play, but the reality is that it's different in every community from the standpoint of high tax rates and the relationship to services that are being provided by the state or local government. That's not necessarily a one-to-one correlation. So what do these companies need to be thinking about? They try to kind of look at the landscape from standpoint of what they're paying in taxes relative to what they're getting from standpoint of talent development, from standpoint of infrastructure and these issues.
Yep. I will just keep going back to when you're making these business decisions to locate a new facility or expand a facility, that really take that holistic viewpoint, and taxes are one element of the equation. And you should definitely put together a holistic model that takes into account the taxes on a jurisdiction by jurisdiction basis and also takes into account the incentives. But I would so you can really measure that apples to apples, whether it's, as Steve alluded to, one state has a property tax, another state doesn't. Could be very different answers, and it looks like it's the same from the beginning. Same way on the incentives. Don't just go after the big number. make sure that you model that into your overall cost of doing business over a 10 or 15 year period so that you can get that apples to apples. Now, you raise the other point of sort of the quality of doing business in a particular jurisdiction, and sometimes you may make a decision to invest in a higher tax jurisdiction because you've got other reasons you want to be there, and that could be inclusive of the school districts, the quality of life, the higher education, the services, the fact that there's 3 fire stations, not one. They can make sure somebody's going to put out the blaze if there's a problem at your facility. So take that qualitative view into account when you make these location investment decisions, in addition to state and local taxes. Now, yes, state and local taxes can equate to more services, or it can potentially equate to you just have a mismanaged government and you're not getting good services and higher taxes. So do your due diligence, I think, is the message there, and that can come down to meeting with state and local economic development officials to hear their point of view, but meet with your peer companies. They're more than happy to set up meetings with peers that they may relate to your business in a particular jurisdiction, and they can talk to you about the human resources, the talent available in the jurisdiction, the utilities that you pay. Are they fluctuating rates? Are they reliable? How is the police and fire service? What is the quality of the education? Do they send their kids to public schools or private schools? So definitely do a holistic view, take into account the qualitative as well as this quantitative. I can talk all day about the quantitative, but sometimes the fun part, and really some of the part that makes your business more successful down the road, is making sure you've done your due diligence on the qualitative.
Yeah, and I would add to, I'm sorry.
I was going to say, one thing, we talked about doing the matrix, right? That's a lot of work. There are some good reports out there to go look at, like the Tax Foundation. Annually puts out rankings for the various states, and you have to really understand how they do it. Just don't take it. You have to look to see, all right, we did analysis that described partnerships in these states, manufacturers, services, and they'll go through a whole process of ranking all of these states from 1 to 50. Good thing to do some homework there. And if you don't want to spend all the money to have somebody do it for you, just do some more research. I think EY does a business climate index with cost every year, or used to.
Yeah.
So good documents, good periodicals out there. You could do it that way as well.
So anybody want to piggyback on any other resources that they can go to when they're looking at questions of taxes versus services, or the overall industry climate, ecosystem?
Yeah, I think underutilized resources. I really like working with the economic developers in the states and localities, because what we're finding, or my perspective, is that the states, the people who represent the states, have a real good sense of what the industry clusters are and what their particular jurisdiction is good at. And if you're coming into the United States and you're a pharmaceutical company, I think there's 2 jurisdictions that you should go to, right? That's just what I think, but maybe there's 4 or 5. But I think that going to those people and talking about how you want to move in the U.S. and talking through your story, you're going to get a much more sympathetic, I think, hearing, especially when it comes to a discussion of maybe incentives to offset some of the additional costs in going to a high-cost state. Because it's likely that those industry clusters are written into their strategic plans locally. And those are, I think, underread. Nearly every jurisdiction in the United States, or at least they should, have a strategic plan that's written, available. Google it, you'll see it, and that's what I would do if I were looking at jurisdictions in the U.S. is to see how I fit in to the overall industry.
If you're talking to local economic development representatives, they'll often have a really good sense of the pulse of the region and what about their businesses, how they're thriving, what they're struggling with. So what are the really unique dynamics of that location?
Yeah, and if you do go and get an offer, let's say you're going to come to the U.S. for the first time, and you go to a state, you present it to the state, city, county, and they give you an offer, 9 times out of 10, they're going to throw everything on there that they can think of, including standard tax exemptions, along with the property tax abatements and other programs out there. So they are a good source of information. You just have to really understand it and see if it's applicable. And if it's actually statutory, right? It might be your right. If they put on there you get a manufacturing exemption, it's a good number. It's really not a true incentive in our world. It is for the companies, but you might want to go back and try and get another type of program that might be there.
I would just comment, to John's point about certain states are going to have focus on different industries and sectors, and I would agree with that. I would highly encourage everybody to make sure they go out to the trade show. You've got virtually every state engaged and out in the main ballroom talking about the attributes of their state. And if you are walking up and you're in a particular industry, I would ask them, what is your focus in your state or local jurisdiction on our particular business, and see what they say. You'll find out who has a strategic plan and who is sort of operating as a generalist. But I do think that I would just go back to, it's very challenging to just say there's resources out there that will give you the right answer. We almost put, anybody here from the Tax Foundation? Well, the Tax Foundation does a great study every year. We keep talking about the methodology, and we do state and local taxes for a living, right? And I sit in my home state that ranks 42nd on that study, and I know that my brethren from Ohio would cringe when they see that. One of the large reasons is there's a municipal tax in Ohio, but not every state or not every city or part of Ohio has that municipal tax. So even though 80% of the state may not be covered by that, because they've got an extra tax, they run down to 42nd. So our former Governor Kasich would be very upset to see he's 42nd. And if you look at the cost study or some other rankings, they wouldn't be quite so low. So you do have to do the diligence. There's high-level diligence you can do to really try to give yourself that apples-to-apples comparison, but it's really challenging to look at Site Selectors Magazine's ranking of the best places to do business, or CNBC's top states, and really get a apples-to-apples answer that you can. I always talk about when we make these decisions with companies, help them make the decisions. A lot of people who are in that site selector role for the company, they may be doing this not on a regular basis, but as a one-time, you're the project lead on making our U.S. expansion work. That's a really big job. That's a really important job you want to make sure you get right. And so taking the time, and maybe it does require you to spend a little bit of money to have to do that Excel spreadsheet, if nothing else, that really can lay out each of the states, their attributes from a tax perspective, from a labor perspective, from a labor availability. You know, we have 40 or so factors you can look at. Find out what's most important to you or the people that you work with, and then do the apples-to-apples analysis, at least on those 5 to 10 factors that matter to your company's success. Lots of good websites out there to get more than anecdotal data, but sometimes the statistics don't apply on a very micro basis that is really necessary for you to look at when you're looking at it from a go, no-go decision, recommending to your team overseas that we make this investment X state versus Y. Those can have long-term business implications. We want you to get that right.
I'd say one thing, a lot of states, there's probably 3 or 4 I can think of right now, has some tax-free zones. All right, like Pennsylvania has something called a Keystone Zone. You've got New York came out with Startup New York, I think it was called. So if you go there, they say you're going to get out of paying state and local taxes, or a certain percentage of it. That's true if you're not in the United States. You might be able to plan it to come into that spot and get a nice exemption for a long term. They're very few and far between. When you talk about 50 states, there might be a few of them out there. Something to think about. So when somebody calls me and says, hey, we're going to put a sales office in, and we're in high technology coming in from another country, well, let's look at one of these zones, see if it makes sense for you. You know, that could be a nice benefit.
So as you're standing outside the country, and you're putting your shoes putting yourself in the shoes of an investor, what are some of the common misconceptions that you think they have, or that you are aware of that individuals have about investing in the United States?
I can go. I think that the biggest misconception I see is that this seeking out of perfection. So as Donnie was saying, there's 5,000 taxing jurisdictions in the United States. You could spend an infinite amount of money complying with all these rules. So we typically recommend risk-managed approach. Focus on. Yeah, the United States is a big place, but about 5 or 6 of the states, you add them up, that's half the economy. And they're the ones that you know, right? California, New York, Florida, Texas. Deal with those, right? Make sure you get those right. And then figure out, big picture, how is your product, service going to be taxed? There are some common themes among all the states and how things are taxed. Property tax, nearly always is local, right? It just makes sense. You own property. Maybe you have inventory in a particular state. It's going to be local. It's going to go to a school district. Everywhere. right? Sales tax, in the United States, we still limit our sales tax to tangible personal property that's sold to a customer. Now, we have some exceptions, but that's the majority of it. So if you do a service, probably not going to be heavily subject to sales tax. They're exceptions. There are exceptions to everything I'm saying. But big picture understanding is very helpful in the United States, and that's typically how we do it. We focus on the big states. We focus on what exactly you're doing, and then think through what your risk is, and then that's, I think, how we advise, especially inbound companies into the United States, how to deal with the complexity.
I said my biggest misconception when companies call and say, all right, we're going to come to the United States, talk incentives, right? They think there's a pot of cash out there that they're going to get. And when we start educating them that, no, all these taxes, there might be an incentive tied to each one of them, they don't really understand it. They expect to get $3-4 million or something. No, you're going to get abatement of your property taxes. Your what? Yeah, property taxes. So you walk sales taxes. So you're showing that it happens over time. That's the biggest thing for me that I see.
Yeah, I would tend to agree with. Oh, I'm sorry. Go ahead.
No, go ahead.
I just would say Steve's comment is spot on relative to particularly some of the Asian inbound work that we do, where there are countries with very much of a centralized subsidy mechanism that our clients are used to, and they are accustomed to paying taxes long term, but really viewing the first 5 or 6 years as a startup, and that they really need that cash subsidy in order to spend that time to get operational and begin to be able to turn a profit. So the U.S. system, from an incentives perspective, yes, there are a number of state and local governments who do have cash funds for economic development and are willing to spend those on the right economic development projects. Many of our incentives are very much, pay as you go or earn as you go. As you pay some property taxes, you get a component of it rebated, or as you pay income taxes for new jobs, create new payroll taxes, you get a piece of that rebated. So there's definitely a misconception, I think, that happens. Again, we try to dispel those early on and really try to take the long-term view and look at how will these funds come in to reduce your overall cost of doing business, to make your financials work on this project long-term, as opposed to making all about the upfront subsidy. But that's definitely an issue that does come up because it's just a point of view that they're used to, and thinking this is the way we do business. Some states are willing to try to move the incentives up to accommodate that, but not everybody is able to be in a position to do that financially.
So if you want to get a look at all these complex tax credits and incentives to get a sense of where they are, how many there are in each state, what the certain attributes of them are, how you get them, which sort of taxes they're applied to, you can use a search engine and look for SelectUSA State Incentives, and you should find a page that's managed by the Council for Community and Economic Research, which has a database of over 1,000 programs that reduce your tax liability, broken down to tax credits, tax exemptions, deductions, deferrals, preferential rates. This also includes the grant and loan programs that are available, but focused on those kind of today that reduce taxes. There are about 538 tax credits across all the states, 289 tax exemptions. And these are very detailed things with thresholds. Some of them, the threshold is create 50 jobs. Others, it's create 5 jobs. Some of the investment thresholds are $1 million investment. Sometimes it's $25,000. So it can be very varied.
And it depends on the industry. So real quick check, some of you, what are some of the industries that are represented here in the room? Anybody from manufacturing sectors? Financial technology? Biology, life sciences? One. What else we have in the room? Pharmaceuticals? Anything else? E-commerce? Okay, so those are just a sample of what's in the room. So as you think about, from your experience working across the country with different jurisdictions, are there any particular innovative or new type of tax structures that people are putting in place just for some of these industries that are mentioned here in the room?
I think the job tax credits and investments and training are being applied in really new ways, and even grant programs, folks have a lot of opportunities to be creative, to join an existing cluster, an existing collaborative of employers, to look at accessing those funds to create relationships with community colleges, and that can either be on the tax reduction side or grants and loans for those programs.
Yeah, I agree. That's what I see. I see more creativity at higher ed. So our university system's taking a more active role in business development pretty much everywhere.
And I just want to say, not just four-year universities, but the community college system have a really robust network of community colleges in some states.
Some of these incentive programs out there at the state level, right, are now saleable. So some of these organizations that are here, you might not be profitable for years, right? So just because somebody gives you a $10 million credit, most of the time you don't get to use it because you have no liability. States are starting to understand that, and they're now allowing you to sell them for maybe 80 cents on the dollar. Likewise, you can buy them. So if you're coming in and you're really taxable really quick, you don't have incentives, you may be able to buy some of these credits out there. Again, 80 cents on the dollar, give you a 20% discount. So we've seen a lot of that happening now, and certain structures being set up just to capture those and either sell them or buy them.
I know the film industry is one where they're doing a lot of that through those transferable credits and that.
Right, absolutely.
Yeah, I would just comment also in manufacturing. We look at all these different types of state and business taxes. I mentioned earlier that 70% typically is from sales tax and property taxes. So certainly you've got states saying, listen, we're going to extend the property tax abatements or effectively a free period, if you will. If you're 100% abated, you won't pay those property taxes on your equipment and on your real property. Those can last typically, 20 years ago, those were 10-year abatements. Now we see them 10, 20, 30 years, trying to really keep your costs down by allowing you to get those abatements. But also on the gross receipts taxes, they're based on the sales outside of the state, and that's the only factor. So you have receipts, but you don't have to pay taxes unless you're selling them within the state. So that really, if you get a tax abatement and your equipment, machine and equipment exemption on sales tax, you're not going to pay property taxes or sales taxes or income taxes in some of these states who are really trying to attract manufacturing. It may be for a period of 10 or 20 or 30 years. If some of these are transferable credits that Steve's alluding to, and you can sell those credits, you can immediately receive those funds and help fund your initial project investment, whether that's purchasing an old brownfield facility or putting up a new facility. And to that end, I would say that we've seen a number of states move toward brownfield incentives. We have got a lot of plants that are still vacant around the country, old facilities that are maybe 5, 10 years vacant, and they really want to get those back online. And there's an investment that has to be made to get the utilities up and running, get them back and functional. And so the states really are focused on those. Many of those sit in opportunity zones, so there's a federal benefit on top of that as well. I'd also, one more comment alluding to what John said earlier about higher ed and Allison's comments about training the workforce. In a period of low unemployment, and that's also something definitely to look at. If you're looking to invest in the U.S., we have a very strong economy right now. You want to make sure you have employees and the right type of employees that can actually help you in your business. And the economic development agencies have gotten very focused on this issue of retraining, of upscaling the workforce to make sure that they have recruiting programs in place. They've got education programs in place that can be on-site at your facility or at a local community college. And they will help you from really the thought to finish of having somebody apply for a job, advertise for you, get them trained, and actually get them into your workforce until you're up and running. So it's certainly a trend in this tight economy, a tight labor market to have economic development agencies really trying to take opportunity of a great economy and upscale the workforce.
So you guys have been talking about a lot of complexity up here. So what are some of the common state and local tax complications that firms encounter when they're investing in the United States?
Not registering everywhere they should.
I would say I see not enough coordination among service providers. So and treating the foreign situation, the non-U.S. situation as separate from the U.S. situation. And I think what I'd recommend is make sure in your planning that you have the non-U.S. income tax people, the U.S. federal people, the U.S. state and local coordinated in kind of what is the big picture plan in the U.S. because, and I focus on basic stuff, right? So if you plan to be marginally more profitable in the U.S., well, then you should think in terms of maybe flowing some marginally less profitable operations into the U.S. and vice versa. So high level basic is where I would start. I don't see enough of it.
So your comment, Steve, really kind of pointed to this question of compliance. So how can companies really make sure or ensure that they're, have their kind of ducks in a row to make sure that they're compliant in all the different jurisdictions that you mentioned?
Really work with the service provider, because you have to understand where your sales, if you're registering for sales tax, you're going to have 50 states. A lot of local jurisdictions also are going to make you required to file some sort of registration. But Louisiana, they have their own, every parish can do different things on sales tax, right? Texas, you could do certain things on some sales tax. So all these different jurisdictions, understand where your taxes are going to go. If you're doing services, that's different than selling property, completely different. The old property tax rules were if you landed somewhere and you were on the ground, selling something, that's going to be taxable. Whatever your sales, whatever your sales are going to be there, it's going to be 100% taxable. That's changing now. It's changing a lot. And so talk to a service provider, understand where your transactions are going to happen, and make sure you get registered. If you don't do it, then you're going to start getting notifications, notices, and penalties and interest. And they can add up pretty quick.
One thing I might recommend, it's not for everybody, but if you're looking at the U.S. or looking at certain jurisdictions, before you go into a jurisdiction, and it can be a part of the site selection process with identifying properties, it can be a part of the incentives process, also a part of identifying your ongoing state and local tax obligations, is to potentially utilize a request for information or request for proposal from a particular state. And we see this most commonly used with our global inbound clients who are not as well versed in the United States and don't have a compliance function here already. So that really gives you an opportunity to explain to state and local government what my project is, what I intend to do, my timeline for doing it, how many jobs I intend to create, the capital investment, the logistics, where are my suppliers, where are my customers, educate them, and then enable them, the economic development agencies, who will many times work in concert with the taxing authorities in a particular state, to come back to you and describe how you would do business in their particular jurisdiction. Can provide incentives, they can provide potential sites, and they'll also provide their version of each of those 12 plus types of state and local taxes or indirect taxes that may apply to your business. So at least that then gives you a starting point. If you do choose state X or Y, you can look back to that RFP, and at least you've identified the breadth of what you need to comply with in a particular jurisdiction. And then if you've got a team in-house, you can have at it, and those state and local governments be happy to help you, or you can work with the provider to get you off the ground in that first year.
I mean, one of the key takeaways, I think, from today's discussion is complexity. I mean, I mentioned earlier that you have national, you have state, and you have city, you have county. He mentioned parishes in Louisiana. That's a whole different level of complexity. And in some communities, you have school districts at the city level that have taxing authority, but if you're not covered by that, you may be covered by the county district that may have taxing authority. So it's a really complex landscape to play in, but the reality is, going back to John's comment earlier, is the reality that service providers at the local level, they are there to help you, and they will bend over backwards to ensure that you are, making sure that you are compliant, that you can take advantage of all the tax breaks and incentives that are available to you, that you can leverage all the advantages that are available through the community college system, local university systems, and so forth. And so they are a huge wealth of resource for you. So definitely take advantage of those individuals at the local level. We have a few minutes for questions. If anyone have any questions of our panelists, we can take those questions now. There's a microphone right there in the middle, or you can just kind of shout it out if you have a loud speaking voice. No questions? Well, we got one? Okay.
What are some of the uncommon taxes that you see at the state and local level that a lot of companies might just overlook?
Something that catches people off guard, which I think we've talked about pretty much everything, but something that catches people off guard, if they're not used to it, is the personal property tax. So I live in a state that doesn't have one. So I had a client who just assumed the rest of the United States was like our state. And they got some inventory into Texas, and they got it in right before the end of the year. Into Houston, the highest rate, and and they called me and said, we gotta, we beat the tariff and we got it in, and of course you beat the tariff, was like 1-1, right, 1-1 of 19, and you ask him, okay, where to go? Well, it's downtown Houston. How much is it? Oh, $7 million. Okay, well, let me do some math. It's like $300,000. We'll have to worry about that. So there's some gotcha taxes. I think, to me, that one is the most surprising. I would defer to others on others. There's all kinds of crazy taxes.
Yeah, I would say excise taxes or energy taxes. You might be surprised. You look at your utility bill,
right.
All the different levels of tax that are on there, and those may not exist in every jurisdiction because those are all regulated at the local level. So definitely pay attention to your energy bills. I would say in terms of a trend, I would expect, like much of the United States, that we're going to have over time more environmental taxes. We've got plastic bag taxes. We've got carbon taxes in some jurisdictions, and likely more to come. So keep in mind those as well.
I had one. So something that surprises people in the United States is how significant some of the local income taxes are. So New York City, that's a local income tax. So there's New York City plus New York State, and that's what you pay in New York City. So that tends to surprise people. And I think maybe the general rule I think of is pretty much every large city has some form of additional income or gross receipts tax, except for Chicago so far.
I feel in a way badly, right? We've got people up here who've been doing state and local tax for 100 years, and it feels like we're telling you need to use a service provider. But I think there's a reason we've been doing this for 75 years. It is complex, and we do want to have you make the right decision for your business. And so again, to have some form of modeling to be able to lay this out apples to apples, I can't not leave the stage without saying that one more time.
Yeah, I have something somewhat positive, right? So I think one of the really nice things about state and local tax in the United States is that there are very strong constitutional protections. And it relates to just how competitive the states have been, right? Because they like to tax, every state likes to tax people who don't live in the states. I mean, that's the goal. So, and the ultimate people who don't live in the state are, people from outside the U.S. So there are constitutional protections that the states generally follow and will treat your companies equal or better than they treat, or they should, American companies. So I would take some heart from that. I think it's a pretty strong positive.
I guess it's another note in terms of what your business is. It might be a really good fit with the state. So a lot of international companies, global companies are in traded sectors, value-added sectors. States are looking to partner with.
Yeah, I would say on a positive note as well. I mean, I think that there is you'll find a lot of excitement as you talk to state and local governments about inbound investment coming to the United States. I grew up in Ohio, in Northeast Ohio, which did not have a tremendous amount of inbound investment. Spent my 20s and 30s in Central Ohio, which was very much influenced by a heavy investment from Honda in the 80s that then spurred a tremendous economic development with all the suppliers that located there and then throughout the rest of the Midwest. But very, very much viewed positively then and now relative to the economic impact and really what it brought to the culture of Central Ohio. And I really saw that because even today, Northeast Ohio does not have as much of the foreign investment that perhaps it did 20 years ago. And it's doing well these days, Steve, in terms of the economy, but lagged slightly behind Central and Southern Ohio, who had more of that investment. So I think you'll find a lot of excitement as you talk to state and local agencies about your investments and help you sort through all those state and local taxes.
there's no better place to put the investment than here in the USA.
I think as you go around the country, you'll find that most communities have transitioned from this idea of being service providers to companies to being partners with companies. And they really invested in the idea of how they can partner with you so that you can be successful and the community can benefit as well. And so if you go into it with that mindset, I mean, like I said, there's no other better place to invest, and you can definitely find value add for your companies and for your investors. And so with that, I think we're right at time. These individuals will make themselves available for questions if you like, but thank you all for your time. It's been a pleasure.
Thank you.